Hey, today I am going to be talking to you about debt service coverage ratio loans, DSCR. That's what they're called, debt service coverage ratio loans. So these loans are provided for people that are looking to invest in real estate. It is a loan that helps you buy a home with the rental income on the home that you're buying covering the projected payments that you'll be having for the homes. So the payments for the home will include the principal, interest, taxes, insurance, and any association fees that would be associated with the home. So the whole idea of this loan is that as rent comes in, it's enough to pay the mortgage payment and just a little bit more. So these loans are 1.1, 1.2 to 1, meaning if your rental income is $4,000 a month, your mortgage payment is going to be less than that. So that's the 1-to-1 type of ratio that you have to have more coming in than you do on the debt. So there are different lenders. They all have slightly different programs, but the general gist of it is that the income provided from rent on the house or townhouse or condo will pay and cover the mortgage payment. So these loans are great loans because they're not looking at the individual that's purchasing the home's income personally. You don't need to have a job or show that. That's not even required as part of this loan underwriting. They're just looking strictly at the cash flow coming in and how much you have going out, and does that make sense? So in terms of no employment, no job is going to be needed, no tax returns would be needed, no W-2s or pay stubs, anything of that sort would be needed. What you do need for this loan is you need to have decent credit score. A minimum would be 640. Ideally, you'd want to have a higher score than that, but they can't go down as low as that. The minimum down payment, there's a few, not that many that go down to 15%, but 20% is really where you want to be starting at. You want to put at least 20% down on these loans, and then you need good credit, you need the 20% down payment, and then you need to be able to source your down payment and document where your payment is coming from. So they're willing to see that you have your 20% down of the purchase price, plus the closing costs, plus 6 months reserves. 6 months reserves is basically 6 months of payments on the house that you want to see. Once you close, you have 6 payments in the bank. You've already paid out your down payment and closing costs, and so those assets would be required to be documented that you have that. So in terms of the income, the home would need to get an appraisal, and that's done up front. The appraiser goes to the house, gives the value of the house in the appraisal report, but also more importantly for this type of loan, they're going to come up with its market rent on this house. That number will be used for what the projected income is going to be on the property. So that will be done up front, and that's going to show what income will be coming in. There are other ways to document it that we don't need to go into at the moment, but I just wanted to say, generally speaking, that is how they look at that. If there's a lease in place, there's other different scenarios, an existing lease in place, or if you already have a rented home and you're looking to do a cash out on this, you can with this program as well. Typically, loan amounts are up to about $3 million. Sometimes there's minimums of at least $150,000 minimum loan amount. Can be a foreign national, still qualify for this. You don't even have to necessarily have a house. You could be a quote unquote first time home buyer and be renting, get this loan. You have to be 18 if you want to get into real estate investing, if you want to be able to buy properties and accumulate a portfolio. This is the way to go. It's a great loan. So the two major downsides of this loan are the interest rates on it are higher than your regular conventional loans. So at least you're talking about typically 2% higher than what a regular mortgage would be. just to give you an idea, ballpark. And then the other, these loans is they'll have some sort of prepayment penalty. So that means if you buy the home and it has a, say, a 3-year prepayment penalty, if you were to sell the home or refinance the home within the first 3 years after you obtain the loan, then there would be a penalty, a fee to you at you sold that. And that is dependent upon you, your credit score, your equity, different factors. So the higher the credit score, the better, and the more equity in the property, the better. Some of the things that are going to kind of dictate your rate, your prepayment penalty, and things like that. Lots of lenders really out there can do these loans. Each one a little bit different in what they do, so it's best to come to a mortgage broker that has access to all the different lenders that do these types of loans, that can best put you in with specific needs, your credit score and how much you have to put down and other factors like that. So once you do one, you can do as many as you want. No maximum number of these loans that you could do, so you can to purchase multiple homes, rent, and become a real estate investor with these types of loans. They're really for that. And the only other thing I guess I would say is that you can't use these loans to live in a house. They're based off of the premise that you're going to be get out, and that's the rental income that you would have on this would be paying the so there would not be for like get into a home for yourself and reside in your house.